Stay away from interval funds. I've been seeing more of these interval funds when we take over accounts for new clients, and let me tell you, I am not a fan of them. They appear to be normal mutual funds, but when you go to sell them, you find out you can only sell once per quarter. The other problem is when you enter the sell, the next day you realize you still own shares in the fund. The reason for that is the product's unique structure typically allows investors to redeem just 5% of a fund's assets. I'm sure most people have no idea when their advisor or themselves buy these funds that they will be locked in them for years to come. For example, I first saw these about 4 years ago with a new client, and we still have not been able to fully exit the position. The reason withdrawals are limited is because the funds generally invest in illiquid assets. So managers want to make sure investors can't exit en masse and force the manager to sell securities at fire sale prices. Now, as many of you know, we are not fans of illiquid investments because if things go south, you have no way of exiting these positions in an efficient manner. The allure here for many is that retail investors with less investable assets generally don't have the same access to as many private equity, venture capital, real estate, and private debt deals. So interval funds enable those investors with minimums as low as $1,000 to gain exposure to the space. Gotta say, I would not recommend investments in any of those assets, but it just appears these are sold as a way for people to invest like the wealthy. A big problem here is the fees are just crazy. According to Morningstar, of the 307 interval fund share classes currently available, the median fund's total expense ratio is 3.02%. A big reason for the high fees is they include the cost of leverage, which these funds use in many cases to amplify returns. That doesn't sound risky at all, right? Even if we exclude leverage costs though, the median expense ratio is still 2.18%. Brian Moriarty, a principal on Morningstar's fixed income strategies team, had some interesting things to say after researching the space. He concluded before deducting any fees or incorporating any leverage, there was actually little difference between private credit interval funds and public bank loan mutual funds and exchange traded funds. However, after incorporating leverage, interval funds have beaten traditional loan and high yield bond funds as they've had about 1.3 times exposure on average to such debt in a rising market. But the problem is they will also have that exposure in a falling one. Needless to say, you will not find us buying any of these funds in our portfolios at Wilsey Asset Management. I'm Chase Wilsey with Wilsey Asset Management. If you like these videos, be sure to give a like or comment, and feel free to check out our other YouTube videos and weekly newsletter for the latest economic news, expert analysis, and market insights.